Welcome to The Riff, where writer and investor Byrne Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in. So, as you know, I like to start every episode with the most incendiary person or provocative person possible. This week, it's our friend Chamath. You had an interesting writing about him. So basically, a lot of people don't know, but there was a rumor that IAC bought 10% of Tinder from Chamath for $500 million. But then there was some change to that. Why don't you talk about sort of the Chamath and IAC Tinder product?
Yeah, so this is a Chamath deep cut. It's a story that it happened when I was at a hedge fund, and there was just like this flurry of headlines, and it was interesting, and I'd always been meaning to write about it, and finally got around to it, which turned out to be 10 years later. But basically, the story is this: so in 2014, Tinder was starting to take off. At the time, IAC still fully controlled Match. They hadn't taken it public or anything. They hadn't spun it off or anything, and so people who, like, to this day, people who look at IAC, they tend to do a sum of the parts analysis where they look at the value of the individual businesses under the IAC umbrella, and then they apply some discount, just reflecting the fact that you stick all of them together. It's not necessarily worth the same as if they were independent. And then you kind of decide that you're either betting on a particular spinoff or just betting that, hey, there's this bundle of assets that's a little bit cheap, so happy to own it over time. And that often works, but it's some of the parts analyses, they're always tricky because you always have to ask why. Like, if you can easily calculate the discount, why does that discount exist, and what do you think makes it go away? Anyhow, at the time, Match was this important growth asset for IAC, and one of the big drivers of that, of course, was Tinder. And people really didn't know, like, they knew Tinder was a big deal. They didn't quite know how big a deal it was, how big a deal it could be. You kind of have to make up a number for what you think Tinder is worth. And this headline came out that IAC had bought 10% of Tinder for $500 million. And so that means Tinder is a $5 billion company circa 2014. And so the stock, of course, popped. That was like a big number, really exciting. And then I think it was like either minutes later or maybe like an hour later. It was not too long after, there was a correction, which was no, Tinder actually, IAC actually bought 10% of Tinder at a $500 million valuation. So if you want to take the most just linear, literalist interpretation of this possible, you could say that one headline, the change from first headline to second headline was IAC owns exactly as much of Tinder as you thought, but they also have $450 million more cash than you expected. So in theory, the stock is now worth $450 million more. And in practice, what happened was the stock went down. And the reason for that was investors were trying to guess what Tinder was worth. And the best way to guess what something is worth is see if someone tries to buy it, or see if someone does actually buy a piece of it, and just calculate the value based on that. So it was this kind of funny story to me of what happened at one level was IAC turned out to have more money than we thought. And what happened at another level was, no, the investors' view of the smart money view of Tinder was it's worth $500 million, not $5 billion, and therefore is less interesting. And then there's the Chamath specific backstory is that he was the seller, and apparently the way that he ended up owning, it was actually 11% of Tinder that he owned. Well, apparently the way that this happened was Tinder outsourced the development of their first version of the app. The company that developed the app got stock in Tinder. That company, Chamath was able to invest in that company. The company's other operations, like it was an app studio business, it was able to sell that to somebody else, and he was able to keep just the Tinder stock piece. And I don't know the mechanics of that deal. I'm assuming it was something like asset sale, and that the surviving corporate entity just stuck around, and that he bought the rest of it. And so it was kind of a clever way that you, anytime a company is in some kind of business where they occasionally take stock instead of cash for the work that they do. And if that company works with small growth companies, there can be some point at which most of the value in that business is actually the stake that they have in some other company rather than their business on its own. And there have been other cases that were kind of analogous to this. Like there was a point in the 2000s where I think it was like 3Com owned Palm. So not the same kind of story, but 3Com owned Palm. I think they took it public, and there was this brief period where Palm, like 3Com, the entire company was worth significantly less than just the value of their stake in Palm. And in that case, it was like sometimes these things look like market inefficiencies, and sometimes it's like there is an inefficiency in the market's ability to make itself efficient. So in a case like that, where there's a company that owns a big block of stock in some smaller company, and then a smaller piece of that stock is trading, you might want to arbitrage that. So you would short palm buy 3Com, and often the difficulty there is just it's very expensive to borrow because everyone sees that as a risk-free trade. So they're all doing that. And so at that point, the kind of meta efficient thing is that the cost to borrow this stock ends up being a reflection of the market's, like the average market participant's estimate of how quickly that gap collapses. And I'm actually not sure how the Palm 3Com thing ended up resolving, other than both stocks went way down. So at least you made money on the short side. But there are cases sometimes where there will be some of the parts thing where you can actually arbitrage it, like you buy the company that owns an asset and then you short the underlying asset, and sometimes it's the cost of doing the short leg that actually turns that from this is a really good trade, it's risk free, to this is a way to just continuously incinerate small amounts of money until some unspecified catalyst happens that actually resolves the gap. But also, it's just like what I think like the meta story here is that when we talk about markets being efficient, we don't actually assume that anybody has perfect information. Not just like investors don't have perfect information about the company, but even the people running the company have very imperfect information about how the company operates. They do not actually have just day-to-day information on every little detail of the company. And CEOs of big companies employ lots of people who understand mission critical aspects of that company far better than the CEO ever will. And the CEO just kind of has to assume that this person isn't lying to them. Like if you realize that your company could be hacked at some point, so you hire some infosec person, and you're hiring them on the basis of this person knows more about software vulnerabilities than I do, this person knows more about best practices than I do. Like it's possible that they're just faking it, and you just, as a CEO, you wouldn't really have any direct way to know. So everyone is kind of trying to do their best with imperfect information, and what we end up with is the system where there's just a lot of outsourcing of expertise, which is just necessary because there are a lot of complex domains where you have to spend many years to just get up to speed, and only then can you actually contribute. And so it does make sense that even if the markets end up being somewhat efficient in some broad abstract sense, it's all because we are trusting some set of experts. Like if stock prices perfectly reflect the fundamentals of every company, that also means everyone is making this massive bet that the accountants are all completely honest, and that the company is also incapable of or unwilling to fool the accountants. So I think that's like the real lesson of that parable, is that efficient market is always this Hayekian kind of approximation, or like it's the end state, like the asymptote that we never actually reach and we just slowly approach. But the more that we approach that and the more complex the economy gets, the more you are just outsourcing a lot of your judgment to experts, and thus outsourcing a lot of your judgment to whatever systems and tools we use to decide who counts as an expert and who doesn't.
That's a good overview. I want to, while we're on the topic, briefly just say something that I find interesting about Chamath. It's sort of at a meta topic, which is most great entrepreneurs, for example, are known for their successes, but not their failures, right? Because failures often go unnoticed. And, Mark Andreessen is known for Netscape, not for Ning. Or, Reid Hoffman is known for LinkedIn, not for the social net. Or
6 degrees, yeah.
Yeah.
Or, no, you're right.
Whatever it was.
Yeah, 6 degrees was the patent he got, not the startup.
Exactly. Yeah. Mark Pincus had a bunch of failed things before Zynga, right? But Chamath is interesting because he's among certain crowds, certain, serious crowds, known for his SPAC controversy or SPAC failure, but not known as much for some of his other bets. He's known for Facebook, but he at one point, I believe, owned a bunch of Bitcoin, or he was a big investor in Slack. Like he's had some really big wins, but maybe because of his personality or because of the nature of how public his sort of misses were, or sort of the nature and how he handled them, he doesn't get the credit he deserves for his big successes. Whereas usually it's the opposite, where people are get the credit for the successes, but don't get the flack for their failures.
Yeah, so there are a couple pieces to that. I think one is there's a general tendency where people, if you look at a stock chart, it's bumpy. It's got ups and downs, right? It's not a smooth curve. But the chart of attention is even lumpier, and what can often happen to people is that they they get their peak public profile at a time when their personal stock chart happens to be at one of those spiky high levels, and so that is when a lot of people are paying attention to them, and then they get to see the decline. And so if you looked over like a 10-year period, you'd see good returns over that time. And then if you look from the period of, hey, Chamath is this really, really famous tech person who's taking public a lot of extremely high risk companies, and then you follow the fortunes of those companies, you're like, wow, this guy was just a complete faker. Like he had nothing, there was nothing behind any of these companies. And I do think like a lot of the SPACs that he did were just not great. And I don't think that SPAC economics are all that good for companies, and it creates a lot of pathological incentives. But I also think that he did, like, as far as I know, some really impressive stuff on the Facebook growth side, and that is actually like growing a company like Facebook. It is this combination of understanding psychology in a kind of collective way of, okay, what is it that actually causes someone to become more engaged with Facebook? What is it that keeps them back on the site? And then how do we actually quantify that and systematize that and figure out what are the set of tools we can use to get someone from they signed up to use this new product they hadn't heard of to they're using this product first thing every day after they wake up, last thing of the day before they go to sleep. There's some art to that, there's some science to that, but then there's also the more one-on-one kind of retail psychology of sometimes, like, one of the big obstacles to Facebook growth at one point was that Hotmail was marking all the Facebook invitations as spam, and there was actually a fairly complicated deal. I think this was the Stephen Levy book talks about this as part of the deal where Facebook took a large investment from Microsoft. One of the terms of that was basically Hotmail is no longer going to consider Facebook invitations spam. And so negotiating a deal like that, it is still understanding people's needs and understanding what makes them tick, but it's understanding a specific set of people who are in one conference room in Redmond deciding whether or not this particular decision is in Microsoft's interest and in users' interests and whether or not it's going to blow up in their faces or whatever. So being able to understand human behavior at those wildly different levels of abstraction, of understanding how 5 or so people who are key decision makers are thinking versus understanding how the next 500 million people who are going to sign up to Facebook are thinking. I think it does take a lot of nuance, a lot of understanding. But then, maybe you look at that and say, well, Chamath was able to get a lot of people to sign up for an app. He's very good at tweaking the variables that cause the average person to make a slightly different decision than they otherwise would. And maybe some of that skill also applies to getting people to buy lots of shares of insurance companies that have pretty bad unit economics, or spaceflight companies. Like, I actually, funnily enough, I owned shares of the first Chamath SPAC in its pre-SPAC days. So when it was just the Social Capital Hito Sophia Holdings, Holdings A or whatever, IPO A was the ticker. I owned it, and part of my bet was like, looking at his career over time, there have been a lot of ups and a lot of downs. And if someone is a high variance person, you want to own a call option on them. You don't want to have direct equity exposure if you can find a cheap call option instead. And the SPAC was basically a cheap call option, because if you own shares of the SPAC, you can just redeem it for cash if you don't like whatever deal they do. And if you do like the deal they do, you keep the stock. And so you get all upside, and then you constrain your downside to just what is the opportunity cost of having shares of IPOA versus having shares of something else. And at the time, I had like enough cash in my portfolio that it didn't actually make a meaningful difference to have this, this basically cash-like instrument instead. And then there was a lot of upside. And there was part of the way to think about high variance people, especially people who like go through these bursts of activity and then periods where they just don't seem to be doing as much, is that if you can basically sit through those periods of inactivity, you're not exposed to whatever the downside is there. You're only exposed to the upside. So if someone has these, every couple of years they do something that either creates a lot of value or gets a lot of attention, then that's what you get exposure to with SPACs. So I end up feeling like the Chamath SPACs were like really good assets to own before they de-SPACed, and that really only works as a thesis if they will tend to acquire companies that get a lot of retail investor attention, don't necessarily pan out well. But I also think like some of this is just a market timing thing. It's that if you take a lot of companies public during a wild bull market, there'd been in when the SPAC boom happened, there had been this long period where it was just non-trivial to take a tech company public. Like companies needed a pretty decent track record. There were a lot of interesting companies that maybe in the 80s or 90s would have gone public a lot earlier. And in the 2000s and 2010s, they were just staying private and raising growth capital. That meant that a lot of average investors just didn't have the opportunity to invest in these companies in the really early stages. Like Microsoft was just, by modern standards, not a huge company when it went public. Neither was Oracle, neither was Intel. These were all just pretty small IPOs when they happened. And if you started a company like that today, you probably wouldn't be taking it public until it was worth $5 or $10 billion. In fact, the higher quality the company is, the longer it can wait to go public. So you have stuff like Facebook not going public until it's worth like 100 billion plus. Which is, it's unfortunate certainly from the perspective of someone who likes looking at growth companies. Is like, it's nice to be able to look at this company when it's still young and scrappy and not to have to wait until it's this fully institutionalized business that is going to almost immediately qualify for S&P 500 membership, et cetera. It is a little sad that we miss some of those growth opportunities. But if there have been a lot of structural forces that changed in such a way that it just makes less sense to take a growth company public in the US at an early stage, then if you do it anyway, a lot of the deals will just not make that much sense.
That makes sense.
Hey everybody, Erik here with a word from our sponsors. Fast forward to the end of 2024. Think about your goals. What can you do right now to give yourself the best chance of succeeding? If learning a new language is on your list, you absolutely need to check out Babbel. Babbel offers a range of learning tools, self-study app lessons, live classes, and even podcasts, which have always been my favorite way to learn. Studies from Yale, Michigan State University, and others continue to prove Babbel is better. One study found that using Babbel for 15 hours is equivalent to a full semester at college. Babbel isn't just a game to kill time and make you feel like you're learning a language. It's not overly academic or rigid either. It's all about learning language for the real world. Babbel stands out because it's designed by real people using a modern conversational teaching approach. It's not always easy, nothing worth doing ever is, but it's straightforward and designed to help you start speaking in just 3 weeks. With Babbel, I was able to brush up on my intermediate Spanish to ramp up for travel to Argentina last year, and was able to set clear goals based on how much time each week I wanted to practice. Join millions of Babbel language learners across all age groups. Here's a special limited time offer for our listeners. Right now, get up to 60% off your Babbel subscription, but only for our listeners, at babbel.com/zen. Get up to 60% off at babbel.com/zen, spelled BABBEL.com/zen. Rules and restrictions may apply. If you don't already subscribe to Turpentine's industry-leading newsletters, like our new daily AI newsletter, Emergent Behavior, or Media Empires, you should. But that's not what I'm here to tell you about. The platform we use to power these newsletters is called Beehiiv, and it's excellent. First of all, it was started by the same early team who helped build Morning Brew into a $75 million newsletter business. And they built Beehiiv to offer that same powerful functionality to anyone sending emails. From essayists to business owners, the platform is beautiful, their text editor is intuitive, and they help you scale your audience with custom growth features. Beehiiv has powerful tools to help you monetize your content. You can easily launch paid subscriptions or pursue an advertising model. The Beehiiv platform will even connect you to premium brands to sponsor your newsletter. Not only do we use them, but thousands of the top newsletters in the world also use them, like Milk Road, Blockworks, the Lindy newsletter, and so many more. Beehiiv's founder hooked up Moment of Zen listeners with a sweet deal. Get 20% off for 3 months with code MOZ. Visit beehiiv.com, that's BEEHIIV.com, to get started.
I want to segue to something else you wrote about this week, which I'll actually tie back in a minute, but is threads and Twitter.
Yeah.
There's this idea that Twitter has become a lot more right-wing recently, but actually it seems that just a lot of the left-wing energy went to threads. And so you wrote about a different way in which threads is speedrunning Twitter, but let's talk about that.
Yeah, I guess the ideology thing, I don't know. There's people tend to feel a lot more open-minded than they are in practice. And it just tends to be kind of unpleasant to talk to someone who is well-informed but disagrees with you about important issues, or is like uninformed but is also just really nasty about the things that they believe. So it does make sense that there would be some ideological clustering, and Twitter, like, it has definitely had more of a rightward shift, and part of that is that Elon did basically extend the right end of the Overton window by unbanning a bunch of people who'd been banned in the past, and a lot of those people, like, they're definitely not people who are contributing to the mainstream conversation on live political issues, but they do affect what is just the midpoint of acceptable discourse. And if you make the right tail of acceptable discourse a little bit further out, then that shifts the center, just because that's where the new center is. And if that's also just really uncomfortable to people who are of a center left and beyond persuasion, then a lot of those people will migrate to other sites. But there's also an interesting dynamic where Twitter, like, it still seems like Twitter is more of a place for, like, farther left stuff, and it's certainly, there's like a lot of pretty vigorous debate on Israel and Palestine type issues. And I think part of that is that Twitter is just it is a better product for being hostile to strangers. It is, like, things like retweets and, like, quote tweets, and especially quote tweets where other people can see the interactions that are happening on the quote tweet. That's just a really, really good tool for mercilessly dunking on people, which means that Twitter does actually incentivize users to find the dumbest person on the other side, highlight their views, and that kind of further entrenches each side's view that the other side is just morally monstrous and also can't spell and also doesn't know basic historical facts, etc. And Threads just isn't really designed around that. So I think Threads is probably just more of an intrinsically centrist product, and that it's going to, like, if it is center left, maybe it is because the, like, people who are opinion makers on the center right do like to hang out with people who are further on that fringe, which is just, again, it's like a political universal that if you, like, you are probably going to be close to the midpoint of your friends in terms of political views. So if you are center left, you'll have friends who are socialists, or, friends who go further than that. And you'll also have friends who are just centrist. And if you're center right, again, like, you've got friends who are centrist, you have fewer friends on the left, and then some friends who are pretty far out there on the right. So I think that is probably how those kinds of things emerge. It's possible that Elon is just putting a thumb on the scale and saying, like, we're going to do sentiment analysis, and if you say nice things about Trump, you get put into more people's feeds, and if you say mean things about Trump, then you are lucky to get 1 or 2 likes. But probably not. That is hard, and Twitter is kind of short-staffed at the moment. So I think that usually looking at just what is an organic phenomenon that could emerge from slight tweaks to overall rules is probably the better framing. But the other piece I wanted to write about on Threads was just, you can look at Twitter as, like, it was trying to explore this space of, like, what does this product actually look like? Like, we know some people like it. We need to find ways for more people to use it. We'll launch these features. We'll curtail these other features, et cetera, et cetera. And you can kind of view it, I would say it's like if you are playing a video game and watching a recording of a Twitch stream from a kind of mediocre player and looking at all the cases where they backtrack and things. Like, if you do the same things that they did and just omit all the mistakes that they realized were mistakes, then you end up with higher quality play. And the fact that a lot of people wanted to find a Twitter alternative was just this great opportunity for Threads to get a bunch of those people on, have enough critical mass that there is actually a conversation happening on Threads, and then they could go through the entire Twitter product roadmap of things that launched and then got killed, things that became core to the product that maybe made it worse in some ways, and they can just pick and choose, like, which of these things are actually things that we think would make this a durable, useful product, and which are not. Threads also has the advantage, unlike Twitter, that monetization is just not an existential thing for them. I'm sure Threads is perfectly, like, useful as a strategic asset that Meta can choose to monetize at some point in the future, but they really don't have to monetize it right away. Whereas with Twitter, they did need to show some performance numbers. They needed to show some way that that this would eventually produce revenue, and so they did have to go for growth in a way that that Threads does not. The specific Threads announcement that I wrote up was that they are working on an API, and there was this long-running drama with Twitter and its API and outside developers that was definitely there before Musk, and then this is a case where Musk looked at what the previous Twitter management did and said, no, the problem was they didn't do enough of this stuff. So when Twitter, early Twitter, had a really open API, you could build a Twitter client. There were a lot of really good Twitter clients. There were Twitter clients for different use cases. There were ones that were just like for casual users. There were like mobile apps. I think, I don't remember if like the first way to access Twitter on mobile without just sending a text to the right shortcode. Like, I think that was a third-party app. I'm not 100% sure on that, but there, like when I first started using Twitter on my phone in 2009, it was like third-party apps were better. And then Twitter realized that these third-party apps, they have some discretion. It's better user experience, especially if it's like an app where people are charging $3 for a Twitter client. Like if you charge $3, one of the value adds you could have is, hey, we just won't show you the ads. Like we'll pull your timeline. We won't pull the other stuff. You'll enjoy that more. And so Twitter realized this was actually a pretty big threat to their model. And it was also, I think there's like this soft IP ownership thing where, yeah, it's your tweet, not Twitter's tweet, but it's still Twitter's Twitter. Like they did actually build up this network. They did identify the set of features that made people really willing to engage on the product. And so it made some sense for Twitter to try to get more people onto their main app. You can definitely say that with hindsight, they probably could have found some way to charge for the API such that they could be indifferent to whether you're using Twitter on the official Twitter client or on some third-party client. And that if they did that, you'd probably have like 20 different ways that people, like 20 different apps that are for some Twitter specific use case. Like there's, you could imagine like a Twitter client that's just for traders where it is looking for market chatter. It's looking for rumors that are bubbling up about particular companies, but it's not the main Twitter app. And then you have like corporate Twitter, and there are some the big companies like Hootsuite and the like, where they were basically the tool for, you want interns writing tweets, but you want some adult in the room to read these tweets before they go out to the general public and just make sure it's not something insanely inappropriate. Those companies largely did just pay for whatever API access they needed, and it worked out for them. But I think there was more room to find other ways that people wanted to use Twitter, the network, like Twitter, the protocol, rather than Twitter, the company and product. And it's just hard for companies to define that. If they end up accidentally creating a communications protocol, and Twitter basically did that. Like they defined a protocol where here is the size of a message, here's the metadata associated with it, and here are some interactions that other agents using this protocol can have with that message. Like that is the kind of thing that could just be codified as an RFC. And, if we thought of the idea of Twitter earlier, it would have just been something that existed in a plain text document on some Usenet group for a long time, and various people would build various implementations of it. But having ownership of something that is a protocol is actually valuable because it gives you an incentive to improve the protocol and to figure out what the weaknesses in that protocol are. And this is like, I do have this theory that like some protocols do end up getting de facto privatized, and SMTP is one of them, where it is basically owned primarily by Google, but really by a consortium of other big tech companies, but Google's the main one, where they basically decide, okay, here's the protocol as written, but here are the actual rules for who can send an email to whom and what an email looks like and what is a properly formatted email, etc. Those are all basically determined by Gmail at this point. And it's doable in theory to just spin up an email server and start sending emails. But in practice, you are probably going to have to either use the infrastructure of a big company or use the infrastructure of a company where part of their competitive advantage is being able to work within the sometimes undocumented limitations that the big companies set on those protocols.
Yeah, that makes sense. I want to segue to something else you wrote, which was about the Trump meme coin. And I want to ask just about meme coins in general, which is it sort of like is there a midwit meme, and on both sides of the midwit meme, it's crypto is just a big casino basically. Like how should we make sense of this?
Like, I don't even know if it quite rises to the level of a casino. Like, usually with a casino, the idea is you can know what the odds are, and you sort of know what the range of outcomes is. But it's not like you walk into a casino and there's a game you weren't even playing and you accidentally made $1 million through no effort of your own, or you accidentally like looked at a poker chip the wrong way and suddenly lost $50,000. So crypto is just like it is different dimensions of randomness. I think of the meme coins, they're sort of like bumper stickers for your portfolio. It's just like a way to slightly inconvenience yourself in order to just signal that you, one, believe in something, and two, you think it is kind of funny. You're not going to be too serious about it. So that's like, I don't think anyone is like, I really need Trump elected, and the best, like, I've already donated the maximum, so the best thing I can do now is buy the DJT token. Like, people aren't thinking about that directly. They're also, I mean, to the extent that they're gambling, it's like gambling on other people who are gambling on other people who are gambling on some hypothetical person who's buying the token in earnest. But really, it's people gambling with one another and just seeing a number bounce up and down, which is fun. Like, we're very much wired to enjoy this kind of thing, and you sort of have to remind yourself that it is fake, and there are other ways to watch numbers go up and down that are probably better for your finances, better for your soul, and more intellectually engaging. I don't know if it's even worth it to come up with like a broader meta theory of what's going on with these tokens, because I don't see any world where they end up mattering that much to the financial system or really playing a meaningful role in anything. They are kind of self-contained, and maybe that is something useful to point out about this era of crypto bull market, although we are recording this on Monday the 24th, and maybe the bull market actually ended today. We'll see. But like, this era, it is a lot more self-referential. It is a lot more like people are doing 2021 parody nostalgia. So in some ways, it's like, that 70s show came out in the 90s, right? Or early 2000s or something, somewhere in that period. So it's like, 20 years, it's nostalgia about this period 20 years before. And now we have nostalgia about this period 3 years ago, where at least some of us were really, really excited about Shiba Inu coin, and really, really excited about, well, people are still excited about Solana, but there was a lot of excitement then that can't be directly recaptured now, because number go down from time to time, and now everybody knows it. And there really isn't a crypto naive audience out there that somehow was not paying attention to any financial news whatsoever 3 years ago, but now has a lot of money to invest and wants to put it in crypto. So at this round, everyone is kind of in on the joke, and there are mainstream tokens that do well, and then there is this long tail of really, really weird stuff that is just kind of recreational, kind of finance as an art project.
Speaking of postmodernism, or speaking of self-referential and art project, you talked about how index rebalancing is unusually postmodern kind of trade. Let's get into that.
Yeah. So this, I don't know why I find this particular strategy interesting. It is one of those things where there are various groups at various funds that are doing this set of kind of esoteric trades, and are periodically, they're generally making money, periodically losing a ton of money. There's a little cycle to this stuff that doesn't line up with the cycle for pretty much anything else. But the basic trade is, when a stock gets added to or removed from an index, people who are passively tracking that index will automatically buy or sell on the date of that asset being added to or removed from the index. And other people who are benchmarking themselves against an index will at least pay attention to a stock based on its index membership status. And this creates a trading opportunity. But there's like a naive strategy of just, if the S&P Index Inclusion Committee says we're adding company XYZ to the index, and it's happening in 2 weeks, that you buy the stock now and you sell it to the index fund in 2 weeks. And that literally works until someone else has the idea of, I will read the same press release and make the same trade. And now the trade switches from that to the tougher trade of trying to figure out how much volume is there betting on this stock being included, and how much volume will actually come into the stock, and at what point, and will anyone who is approximating the index return but does not actually have a legal mandate to directly match it, will they be doing this trade with different timing, etc. And then you have the other metagame of, okay, if you know that being the announcement of index inclusion is going to move stocks, then you start trying to figure out, how can we predict it? And in some cases, it's pretty straightforward. Like, large company goes public, they will qualify for S&P 500 membership. They'll be towards the middle of the market cap ranking. So of course they're getting added. And then in other cases, it's like a judgment call of, this company does qualify, but there's a little bit of hair on the deal, and so maybe it won't actually get added right away. Like, maybe there's some weird governance thing, and sometimes the company changes its governance thing. So companies like S&P 500. For a while, there was this thesis around the publicly traded asset management companies where they were technically partnerships and not corporations, and they switched to corporation status despite losing some tax advantages because it meant they could be included in the index, and that I guess mattered more, and maybe give them some other forms of flexibility. I'm not 100% sure on that, but then there was also Berkshire Hathaway, where it's just really hard to include a company in an index fund if shares trade for several $100,000 a piece. And between Berkshire doing a different class of stock and then splitting that class of stock so that it actually got cheap enough that it made sense for index inclusion, and also the S&P committee basically saying, fine, like Berkshire is too big a company to ignore. We have to have it in the index. So there will be special cases for companies like this. Like, it's literally, if you read their index inclusion policies, there are just many times where they say that the exceptions are spinoffs, mergers, and Berkshire Hathaway, which is like a cool legacy for someone like Warren Buffett to have. It's like there is a special rule just for him, just because he insisted on running his company in a particular way. But anyway, so what we did was we looked for the piece on this. What we did was we looked at the all of the S&P 500's inclusion and exclusion decisions going back to 2014. So this was done. Most of the research was done by my associate Darius, and what he was doing is backtesting various trading strategies of, okay, what if you just bought when the change was announced and then sold when it took effect? What if you bought when it took effect and then just held a little bit after that and assumed that there are going to be some people who are laggards who buy the stock after it's included in the index? And then what if you had perfect foreknowledge and you always bought companies a couple weeks before the S&P index inclusion committee announced they were being added? And then we did the same backtest for what if you sold in advance of or coincident with a company getting removed from the index. And it turns out that the selling one just didn't seem to produce any interesting returns at all. But for the strategies of buying ahead of index inclusion, it was basically like you would generally make some money if you had perfect foresight and bought a couple weeks in advance of index inclusion. And you would also make a decent risk-adjusted return if you bought on the announcement date and then sold when that announcement took effect. And the risk-adjusted returns for that are actually really close to the long-term risk-adjusted returns for just broad asset classes. That it's basically for every point of variance for every point of variance you're willing to tolerate, you get about 40 basis points of annual return above the risk-free rate. And when I was thinking about that, it kind of made sense that it is like taking a risk, and it makes sense that it would be just priced as you're putting your money at risk, but it's not the same risk as equity risk because you're not really betting on the growth of the broader economy. In this case, the exact mechanics of the trading strategy we looked at were you are hedging your market exposure all the time. So every time you are buying a stock ahead of index inclusion, you're also shorting an equivalent amount of the S&P so that you're just capturing the idiosyncratic return of that stock. But it makes sense that if you are, especially if you are a high turnover portfolio manager and your job is always predict the next catalyst and be on the right side of the next piece of market moving news, that if you're doing that, when a stock is likely to be included in an index or when it's been announced that it's moving into the index, suddenly you either have to get really, really good at the mechanics of index rebalancing and have to have like a flawless model of how do various people who pay attention to indices trade, and how do various people who are trying to make this trade, how do they do it? You could do that, or you could just say, look, I'm selling this and I'll be back in a couple of weeks when it's in the index. Like, now the risk that dominates this stock price is not a risk that I want to take. So you sort of magically pluck this company out of the world of businesses that trade mostly based on their fundamentals, move it into a world where they trade mostly based on predictions of passive flows of money into and out of different stocks. And then it goes back into the regular world after a couple of weeks when it's been added to the index and all of those trades have been made and all of the rebalancing trades have been unwound. So it is like a microcosm of the way that markets are this constant effort to find whose balance sheet is best positioned to absorb this particular kind of risk and who is best at underwriting this particular kind of risk. And when the main driver of an asset price switches, for example, from fundamentals to flows, or from this is a good company to this deal, this merger will or will not close on some timeline, then it makes sense for the ownership of that stock to have pretty significant turnover, and for the marginal investor in that company to be someone who only fixates on that risk. They don't have to know anything about what the company does or how they work or anything like that. They just have to understand how indexes are constructed and how different investors trade around them. So I thought it was a fun little exploration of a small corner of the market. Like small, like there are there are teams that are managing multiple billions of dollars doing these kinds of trades, and some of them have made tons of money. There's been litigation when someone leaves their job at one company and moves to another company and is doing these trades at their new employer, et cetera. So there's like a lot of esoteric knowledge, and that was also one of the things I pointed out in the piece is like what we're backtesting in this piece is what you think of as index inclusion trade beta. It's like, here's the general factor that you're exposed to if you do this strategy. Here's its rough risk-adjusted return, in the same way that you'd look at what is the rough risk-adjusted return of stocks. And then if you're actually doing the strategy for a living, your job is not just every couple months read a press release and then make the obvious trade. No, your job is things like predict what's in the press release and try to model the impact and try to model when that impact takes place and try to figure out the optimal way to make these trades so that you have minimal market impact, et cetera. Like there's a lot of nuance to it that is just intrinsically hard to backtest because it's all proprietary stuff and everyone's presumably using different kinds of strategies on this. But even knowing that when you backtest a bunch of these strategies, you actually get something that just looks like market beta, but it's a weird kind of market beta was kind of fun.
That was a great overview. I wanted to return to something I mentioned previously when we were talking about crypto and the midwit meme. I wonder if, and then I'll segue to our next topic, AI. I wonder if because of AI's sort of overtaking of crypto in the zeitgeist of like the new important thing, if crypto didn't really need to, like, it couldn't live up to AI in terms of its impact, and thus it didn't need to sort of have this high moral ground anymore. And in some sense, it could like lean into being more around speculation and making money and having fun. Then it needed to be this thing that was going to sort of save the internet, so to speak. And Chris Dixon is still being the drum, and God bless him. And I'm sure there is work that is being done or needs to be done, but it could lean into being the fun thing. I think partly because AI just in some ways where it's similar to like when an older brother is just so successful, you're never going to catch him. You can kind of like be a comedian or like you want to make your own way. Yeah.
So I will note first, we are officially a venture capitalist podcast in that we have segued from crypto to AI. Perhaps we'll segue right back. We can discuss what's going on the front lines in Ukraine next. No, anyway, I think like crypto, it is very much this creation of, it was like work on Bitcoin started before the financial crisis, but the launch was very much done in light of the financial crisis. And we all know the Genesis block, could have chosen any headline to note that it was done on that date, but it chose a specific headline about bank bailouts. So it definitely made a lot of sense in a world where there's lower trust in the financial system, and also this perception that the financial system is actually even more important than we realized. And that, I don't know that it was like the widespread narrative, but when I looked back on the crisis years later, the crazy thing to me was that the not even defaults on subprime mortgages, like that was a factor, but the actual thing that caused this to turn into a giant crisis was this complete seizing up of the plumbing that supplied just very near-term liquidity between different financial intermediaries. Like that basically, that kind of lending completely stopped, and that was what actually caused this massive deleveraging. If you look back at what people were saying about subprime in 2006 and 2007, their numbers were off in terms of what's the total cost of these defaults, but they did understand that a lot of bad loans have been made and that things are going to get bad for these banks. Like they are going to take a hit to their balance sheet. It was just the magnitude of that hit and the fact that there were so many institutions with so much leverage, and it was just so hard to see where money flowed through the system. And so it was actually hard for central banks to intervene. Like they can inject liquidity in some places, but you needed to get it through a bunch of these different shadow banking entities that were just much more risk averse than they had been a couple of years before. That was like that did illustrate that this is a really, really complicated system. It's a really opaque system. And that maybe, we need something where you can actually just read the source code and see how the entire financial system worked. And I think that dream is like, it is at least worth asking if you were designing the financial system from the ground up, from first principles, would it look anything like the modern system? And to some extent, the answer is yes. Like a lot of things that the modern financial system does are just incredibly useful. Being able to transfer money to arbitrary parties through trusted intermediary entities that actually have a financial incentive to make sure everything works out right. Like that's great, and it is a triumph of the financial system that I can order an Uber, which means I can find a driver who's willing to take me from point A to point B. I can transfer some money to that driver. I assume I'm not getting robbed. The driver assumes he's not getting ripped off. And like everyone, we don't have to know each other to completely trust each other. Like that's pretty cool. But we do end up, to the point earlier about trusting experts, like you do end up assuming that everyone who is running the plumbing of this system knows what they're doing, and that there is in case of emergency break glass kind of contingency plan. And that maybe that system does work better if it's more transparent, more open, and also more programmable, where if you understand the source code, like you don't need permission from anyone to build whatever financial product you want. And then the other thing we learned from crypto is like, if you give people the ability to create whatever financial product they want, they will create either ways to provide a lot of leverage to levered gamblers or ways to gamble with a lot of leverage. So, in some ways, we learned, we were speed running some important things that financial systems have learned about the human condition and just our propensity to make bad decisions. And I do think that because the financial system is designed around the needs of wealthy countries and their need to trade and their need to finance deficits through borrowing, et cetera, like it's built for some use cases that make it unsuitable or less suitable for other use cases. And so there is sort of this race of, can you build an alternate financial system from the ground up where you have no legacy code, you have no backwards compatibility issues, you're just designing things from a total clean slate? Like, can you do that faster than the existing system can build patches and affordances and abstractions that allow you to interact with it as if it were this perfect crypto system that had been designed by brilliant nerds in Silicon Valley with no input from central bankers, et cetera? And I think so far over the last decade, the answer has been that actually the legacy financial system is improving itself faster than crypto is replacing it, but also that crypto has been able to do things like create novel risk-free assets, create novel sources of truth, and then ways to react to those through smart contracts. Like that is really cool stuff. And it's still, I think there will be some kind of efficient frontier where there will be cases where crypto is just sufficiently far ahead of the legacy financial system that if you want to do something involving, say, smart contracts, it just makes a whole lot more sense to use the crypto infrastructure than to try to get Chase on board with your smart contract idea. So in that case, it will actually work, but there will be some scope of things where either TradFi just has an absolute advantage that will never go away, or there is like the crypto maximalist view of, in the distant future, all these financial institutions will still exist, or most of them will still exist, but they will all have crypto, like they will all have Bitcoin reserves on their balance sheet. And that is ultimately why you will trust that your deposit is safe, is that you know that Jamie Dimon does have he has the USB key. He actually has the private keys. Like he's got your Bitcoin, and therefore you know that depositing money in Chase means you still have your money.
Yeah,
which is like, that is kind of a retro thing. Is like the financial system, it used to be that, but with gold, where countries had gold reserves, but people weren't using gold day to day, but they were using currency that was generally redeemable for gold. And then one way that you knew it was a financial crisis was you can't go to the Bank of England and present a bill and get some gold back in exchange. But they would usually eventually get to the point where, you get your gold back. And then eventually we reached the point where we just needed more circulating currency than the gold standard could handle, and had other systems for restoring international balances. And I think like the sample size in economics is always like frustratingly small when you're looking at really, really big, significant ideas. So you could say that certainly the world is a lot richer under a fiat system than it was under the gold standard. That the gold standard era was actually a fairly brief era, and like the quasi gold standard of the Bretton Woods arrangement was also a fairly brief period. Like we've spent more time in the temporary post Bretton Woods era than in the actual Bretton Woods era. But also that just, I think from an elegance of design perspective, there is a lot of positive things you could say about the gold standard, that it has like these really elegant adjustment mechanisms, and it is also just a really good way to keep governments honest, but then has all these annoying inconveniences as well, including just horrific recessions and things, but they're short.
Yeah, that's a good more broader articulation of crypto's benefits than I described. Let's segue to AI labs. We don't know what Ilya saw, but we do know that he started his own lab with Daniel Gross and others. You wrote about how AI labs scale until they schism. Why is that? What's interesting here?
Yeah, I think it's like AI building these models tends to be money intensive and talent intensive, and there's it's like any other business where there's a lag time between when there is demand for a particular kind of capital asset and when you can actually get that asset. So, I talk about this all the time with things like airlines and cruise lines, where you're ordering the plane or the ship years in advance, and then it arrives, and it probably arrives at a point when the economics of the industry are not what they were when you ordered it. And so it's just necessarily true that like supply peaks after demand peaks, and that means there's a price war. So with crypto, or not with crypto, sorry, with AI, it just takes a long time to get up to speed on how these models work, how to train them, et cetera. So a lot of the people who are today able to contribute meaningfully at these companies have been people who got interested when it was a lot less hyped. And that means that these are people who are pretty opinionated about AI, what it should be capable of, when we should launch versus when we should be deferring launches because we're actually not sure we can control this. So you just end up with a staff that is very, very opinionated about the nature of the business that they're in, and of the externalities, and of like what are the moral requirements for working on this. And when AI was just a smaller space, I think a lot of people who were deeply concerned about existential risk, they basically would have to say, I do want to work on AI, and I will probably be able to do more to reduce existential risk if I work for a large company that's actually investing in it, versus just trying to do something on my own and probably not making any progress. But then as there are more of these companies, and as they start adding headcount, eventually you just develop factions where there will be a set of people who say we should be going at maximum speed because this is nowhere near being an existential risk, but we have the business kind of existential risk where we run out of money because our competitors all launch good products, where, well, we're trying to perfect ours, and even if ours would have been better when we launched, if we didn't launch, we don't win. And I think this was kind of Google's wake-up call when ChatGPT took off, was like they could have done that, and they could have done some, like if they had focused differently, they could have done that earlier, but they chose other priorities, in part because they were really worried about the risk of things like bad answers, inaccurate answers, et cetera, and also that it's pretty expensive to serve generative AI results on every single search query, and so I think what happens, like as you add headcount, you eventually get to the point where you are employing more than the Dunbar number. Like people know their friends and peers within the company. They don't know everyone within the company. And you can eventually have different groups within companies that have very different beliefs. And at some point, one group will say, if you are not going full speed ahead, you are depriving humanity of the most important invention of all time, and therefore you're a monster. And other people say, if you don't stop right now until we have figured out how to get alignment solved, and figured out how to prove that we've solved alignment, then you are actually history's greatest monster, and you're introducing this massive existential risk. So at some scale, yeah, people have to leave and start their own ideologically aligned lab. And this has happened with OpenAI now multiple times. And it seems like in a lot of other businesses, people leave because they want to do some different project, or just they're calling in rich. Like they've made enough money, they don't really need to work on this anymore. AI does seem to be unique, where people actually leave for eschatological reasons of like, we disagree with our boss on what actions are most likely to lead to the literal end of the world, and therefore we're starting a different company to have that approach. But what that also means is that it's going to be tough to scale these labs. Like you either have to have an ideological monoculture, or you have to accept that people are going to be spending their very, very expensive time debating the finer points of these issues. And you really can't find good people who don't have strong opinions on those issues. And of course, they're going to argue about them. And sometimes those arguments will result in people leaving and starting their own company instead. So it would be very funny if this actually ended up being what makes AI not an existential risk, is that you simply cannot get a group of people that has enough talented people who care about AI and want to build it, and who also agree with each other on which particular product roadmap will or will not end the world.
Well, we talked about therapists last week. Maybe there's mediators who can help out and not only not be replaced, but also help AI advance somehow.
Yeah, I sort of wonder if OpenAI has any kind of skunkworks project to, they would probably call it de-radicalizing the Oz AI people. If can you build an LLM chatbot that is just really, really good at persuading people that it's going to be okay? And maybe that is the true existential risk.
Yeah. By the way, on this note, I did get a question last week from a listener, Kristen Berman, who asked, in light of our conversation about whether therapists or coders are going to be replaced, does Byrne have any advice on what people should study in college to better be equipped to succeed in the AI future?
I don't think I have very differentiated advice. I dropped out of college. I had some classes that I thought were really amazing, and a lot of them I just would have probably learned more doing other things. So my guess, I think that is probably, well, it worked for me, but I'm always hesitant to give advice on the grounds that it worked for me, because I've also just had a lot of good fortune in my life. But yeah, I think if you choose topics, if you choose to study, and it's probably not at the major level, it's probably at the class level, choose to study with teachers you actually admire, like people where you look up what books they've published, the books are actually interesting, you'd want to talk to the person who wrote that book, and you'd want to know what they have to teach you, that you will probably have some classes that are just massively influential in your life. And a lot of times when people talk about their college experience, they will often talk about a particular class that put them on some different path. And sometimes it's like, this is the class that taught me I'm actually not going to be a physicist, or I'm not going to be a mathematician, and I should major in something a little easier. And sometimes it's like, this is a class that I took because it was a requirement, and then I realized that my passion is for philosophy or sociology or for programming or whatever. So yeah, also, casting a wide net, freshman year, signing up for just a bunch of random stuff in random disciplines. You never know what you'll learn, and you will probably pick up some tidbits that will at least allow you to occasionally drop some piece of trivia that just overawes everybody. There's the classic Steve Jobs thing of I think he took a class on calligraphy or something, and then because of that, he had really strong opinions on fonts, and because of that, the Apple II had really, really good fonts. Stuff like that. You never know what it's going to be, but also it's just useful to cultivate this habit of, if you go to the used bookstore, buy the book where you cannot believe that someone actually took the time to write a book on that topic. And it's probably written by someone who's a lot more passionate than someone who's just churning out stuff that is of general appeal to the average audience. And it also means you will know things that are unique, and knowing things that are unique, sometimes it's just a social power move, but what it also means is that your mental model just has to fit in a lot of weirder stuff. And so you end up kind of less confident in really dogmatic views on any topic whatsoever, but also just a lot more open to the idea that there's just a lot of complication in the world, that sometimes it really is just great man theory of history, that there is a particular person who happened to be born in the right place and right time, and that is why, that's why we have internal combustion engines, or that's why America is very rich relative to the rest of the world. And then sometimes it is these abstract forces. And I think the America being richer than the rest of the world, a lot of that is pretty abstract forces. Things like, it was a continent where you had very comparatively technologically advanced society that moves into this continent where there are a lot of natural resources, just a lot of natural resources. There's a lot of space. That space actually creates this totally new political dynamic where if you don't like your neighbors, you just move instead of starting a civil war or, a pogrom or something. You can just go to the next empty plot of land and farm by yourself. And that just creates a totally different political and social dynamic that just couldn't really be replicated in Europe. So I think, just having, picking stuff that's going to broaden mental models, knowing a little bit about a bunch of different disciplines. It's also useful to know that some disciplines are just more rigorous than you thought. I assumed when I went to college that philosophy was just in the category of like generic liberal arts, like it's not super hard. And then I took some philosophy classes. I was like, this is actually really, really challenging material. Some of it is deliberately obscure, but even when they're being really clear, it's actually difficult stuff to wrestle with. And then later on, I learned that if you look at GRE scores by major, that it's like physics and philosophy are at the top, and that there are just a lot of people who majored in philosophy and went on to do very, very interesting things. That it's just a very challenging field. You have to really keep your thinking cap jammed on at all times to succeed in it. And it's good to know. It's good to know that there are some fields for lightweights and there are some fields for intellectual heavyweights, and also that sometimes like being the one intellectual heavyweight in a field that doesn't require that is just this monstrous competitive advantage that is also kind of a recipe for a fun life if you're not conflict averse.
That's well said. Thinking of time here, but I want to make sure we get to talk about how you are hiring an associate.
Yeah.
Let's plug that.
So I am hiring an associate. And the way that this company has evolved is that a couple years ago, I realized there was just a lot of stuff that I could be doing that I wasn't doing, a lot of stuff where I said I would do it and then I didn't have time to do it, and that was bad. So hired someone to help parallelize things. He was taking a gap year after school, and then after a year went back to school, and then actually went into venture capital. And then I brought on someone else in 2022, and he's been able to do a lot of really cool stuff, like a lot of internal automations. So the diff it's a newsletter. That newsletter is also the top of funnel for a recruiting business. It's also top of funnel for an angel investing thing. And there's just a lot of just piping data from one place to another that has to get done for this to work and to work with maximal efficiency. And he built a ton of that, did a ton of research, talked to a ton of people for diff jobs, and has just been a really, really great generalist. And so I am looking for, like, ideally another generalist. I have like my whole list of criteria. If you go to the diff.co and click on jobs, you will see the big job listing for this. But also I'm just interested in talking to people who are early in their careers and looking for an experience that is going to be very informative, that will give them a lot of exposure to a lot of different industries, ideas, a lot of just kind of random tasks. Like sometimes I just need something scraped and I don't have time to write a scraper. So be very, very helpful if you know Python. But if you are just intellectually curious and you find these discussions really appealing and would like to be part of this process and would like to talk to a lot of other interesting people as your day job, then please reach out.
And I would just co-sign. I've met a few people who have worked for Byrne and in Byrne's orbit, and they're all extremely smart and seem to be doing fun and interesting and career edifying things. I'm also hiring a chief of staff at the moment, and anyone who comes in through the riff or is a fan of the diff, I think this would probably be an even better opportunity. So I will pass them along to you. And great, let's wrap on that. If people are interested, please do reach out. Byrne, is it to you directly, or what's the best way?
Yeah, pinging me directly is good. You can sign up through the general diff jobs process as well. But yeah, either way works.
Through the process. And if you ping directly, do have a compelling, differentiated approach, because I'm sure Byrne is getting lots of applications. Sounds good. Byrne, let's wrap on that. And until next week.
Alrighty, sounds good. Thanks.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.